All right, crew. We are super fortunate to have Dr. Terry Smith on the call with us today. Terry is an amazing individual. He works for a firm, Emerald, that managed $4.5 billion, predominantly in the healthcare space. And Terry's a portfolio manager. So today we're going to get an insight into what's going on in the healthcare space, what's going on in the small cap space, and just broadly speaking, is AI affecting things in the small cap biotech space? Terry is the guy. So Terry, as I kind of try to kick these things off, we've just had this massive sea change about what's going on in DC. Let's talk a little bit about how that impacts healthcare that over the last year has lagged a little bit. Is this a nice entry point into an asset class that hasn't kept up with technology and the Joneses on the upside?
Yeah, Taylor, thank you for having me. You're absolutely right. Healthcare has definitely lagged. I think it's been mostly related to the gigantic capital vacuum that has been tech for the last couple of years. And small cap is also lagged large cap. So at Emerald, we're long-only small cap growth managers. We focus on the smaller end of the market, and that has been a struggle. In biotech, that's my primary area of focus. There's a lot of uncertainty with the changes going on in DC right now. We think a number of them can be actually quite beneficial for small cap firms in particular, and also in the healthcare area.
Interesting. So I would imagine what you're getting at there potentially is deregulation potentially being a boom to what's going on in your space.
So yes, there has been, you probably saw some uncertainty also introduced with the potential involvement of RFK more in the government, and many biotech stocks sold off when that happened. I'm of the belief that, so he's going to be one of the people that influences FDA. FDA stands for Food and Drug Administration. Investors tend to think of it primarily as drugs because we are biotech analysts, so the world revolves around drugs and biotech. But food, I think, is actually his bigger axe to grind. And I think that we've seen this administration before, and they tend to sometimes change course, sometimes change the next shiny object. And I think we're going to see a lot of that going on, which might amount to really nothing so draconian for the biotech space, and things kind of proceeding business as usual. And investors hate uncertainty. And I think once we get a sense for how these first 100 days go, things will settle down really nicely.
So talk to us a little bit about Emerald. Emerald has a massive, what I would refer to as smart money basis. So you manage $4.5 billion. You have literally some of the largest clients being pensions, being large insurance institutions that place boatloads, hundreds of millions of dollars with you guys. Tell me about how they're looking at this from an opportunity set standpoint. Are they seeing this as a chance to add money to a space on weakness?
So, Emerald, we do manage a little over $4.5 billion in assets. We're a diversified fund. So one minor correction I'd say is about a quarter of our assets are in healthcare. 3/4 are in the other sectors that you know very well: industrials, tech, consumer, financial. So I'm one of the healthcare people, and there has been massive headwinds to small cap. We believe that small cap will be turning around as earnings growth accelerates among smaller cap companies, especially relative to their larger cap peers. And specifically in healthcare, we believe that there's M&A that needs to happen. I can talk more about what's going on in the pharmaceutical pipelines. There's a whole bunch of patents that are running out between now and 2030. About a third of pharma's revenue goes generic between now and 2030. Wow. And we're quite bullish on the biotech space because most of the innovation in therapeutics is in these smaller companies. And the big guys, they are finding that it's just easier to acquire the successful ones rather than do their own ground up de novo research and development.
Yeah. Is it fair to call biotech kind of a boom bust space? Meaning if you have a drug or a solution that hits, watch out, this thing can be the next Gilead, next whatever you want to call it, hugely successful company, but they aren't revenue generative typically, or often at least, and you can speak to that. how do you separate the winners from losers? How do you, or is it just a spread your bets and something will play out type bet?
Oh, it's not the latter for sure. So,
close your eyes and throw a dart. That's not what you're doing, Terry.
Biotech is the absolutely perfect area for active management. So there are about 800 publicly traded biotech companies around the world, and it's my job to find the ones that are going to work. As a space, like if you look at it on average, yes, they kind of move together, but that looking at it from that distance kind of shields you from the 400% gainers and the 95% losers. Like this is as you said, it's a boom and a bust, mostly because the barriers to entry are very high. Gross margins are 90+%. So if you have a drug that works, you're very valuable. If you have a drug that doesn't work, you're worthless. So it's my job to figure out which drugs are likely to work and what they're worth if they do work. At Emerald, we employ a 10-step research process that involves, as it applies to me, I do a deep dive into the science so I understand how does this disease work? How does the drug work? Who's tried something in the past and what went wrong with that one? Why is this approach better? I talk to key opinion leader physicians to understand how they would use the drug if it was approved. I even talk to patient advocacy groups to understand what the unmet need for a given disease is. We talk to company management. We attend medical conferences. I do the full gamut just to be as in the weeds as I can on these individual biotech companies to place the bets that I think are going to work out.
So it really doesn't hurt that you're a doctor yourself.
Yeah. So by background, I did a PhD in a subject called molecular toxicology, which is kind of how drugs work. And I also did an MBA. So I interned at Emerald 18 years ago, and I've been here ever since. And it's the perfect way to kind of marry my science and business background. I basically am just always asking, what's this thing worth?
Yeah, you're the dual threat. You are the multi-purpose player. Interesting. That's awesome. So tell me a little bit about getting into biotech. Like, where do you see big innovation coming? What spaces? Is it cancer? Is it, obesity? Obviously, we've just seen, the GLP-1 drugs explode onto the market. Where are you seeing the next level of innovation?
So there about 20 or 25 years ago, you probably saw this news in the press and forgotten about it, but we sequenced the human genome. That kind of meant we know the sequence of what makes us. And it took a while for this to translate into actual drugs. Maybe took 10 or 15 years for this to start coming out. But over time, what happened is scientists were able to say, okay, here's people that don't have a disease, and I'll compare their genotype to people that do have a disease and look for the differences. So you could get an understanding of what gene or genetic lesion is causing the disease. Once we knew that, it was, I don't want to say easy, but it was a next logical step to be able to create drugs that fix the actual genetic lesion that patients have. The area where this is most shown right now is actually in rare diseases. These are diseases that you have probably never heard about, hopefully, because they're usually very, very devastating, very, very rare. They affect between 10 and 30,000 patients in the United States. A company, I can't talk about companies. There's a large biotech company, one of the largest, that has made an entire franchise around cystic fibrosis. So cystic fibrosis is an example of a large rare disease. But there are many other rare diseases, probably about 600 of them that are caused by a single genetic lesion that people are working on right now. The beauty of these is, especially for small cap companies, where their cost of capital is so high, FDA is very permissive in terms of how big of a study you need to get a drug approved. The safety bar is not as high. Like if I want to make the next GLP-1, you'd have to test that in tens of thousands of patients to make sure it is absolutely safe. If you're doing a study for a rare disease where patients often die in 5, 10, or 15 years, you don't have to worry about like long-term bone health things or other things. There are no drugs for these patients. They need to be treated or we know what's going to happen to them. So the safety wiggle room is significantly broader than you have for a mass market disease. And the pricing power is very high in these drugs. You could see the sticker price on these drugs being from $300,000 up to a couple $1 million per year, depending on how many patients there are.
Wow.
And payers haven't done much to push back on this. The out-of-pocket cost to patients is near zero. The health plans look at it as, I only have one or two of these patients. It's not really worth making a big deal out of paying for these one or two patients. And the last reason that this is a real big benefit, especially to smaller companies, is because all these things compress the time that it takes to get a drug to market. So when cost of capital is really high, if it takes you 10 years to get your drug to market instead of 3, that's a gigantic difference to a small company. And these small companies can launch the drugs by themselves. You generally need a sales force of like 10 to 15 people. And there are a handful of doctors, maybe 40, 50 doctors that care for all the patients at genetic centers across the United States. So it really works well from a P&L perspective as well.
Interesting. So one of the things you talk about there is just the cost of capital. And one of the things that's been a massive headwind on small caps in general, and it sounds like also the biotech space is, well, the Fed has been raising interest rates. Now they're on the other side of it, but we've had rates move massively higher in the past 4 years or whatever it's been. Talk about how small cap companies handle that and progress through it, because it's got to be a strain on them.
Yes. Higher rates are definitely harder for small cap companies to outperform, especially in the biotech realm where my companies don't really have access to debt either. So they're using equity. They issue equity. My industry burns about $60 billion per year, and they generally raise that much per year as well from investors like me, hedge funds, and other mutual funds. So in response to the rates being higher, we have seen some narrowing of the pipelines as companies are trying to defray their burn a little bit. But I'll tell you what we have in the biotech space. I told you there's 800 companies. There's about 100 of them that are well-capitalized, high-quality science. Those companies have tremendous access to capital. If they need to raise money, they have it. How much of a discount it is to their share price, that's debatable, but sometimes it's very little, and sometimes the stocks actually go up when there's an equity offering announced because everyone knows they need to raise money. There's another group of companies at the other end of the spectrum. These guys are just struggling to survive. That's the reason there's 800 of them. Probably 400 of them are not even worth looking at. But those companies are narrowing their pipelines very considerably.
Yeah. So an interesting question from a portfolio management standpoint is kind of the frequency versus magnitude conversation, meaning what is a positive hit rate? And if you have, and you can talk about this, how many holdings do you have inside your portfolio and what is the anticipated hit rate? Obviously, you'd love to hit on all of them, but that's not reality. And then, how do you measure the frequency, meaning the percentages of companies that produce positive returns versus the magnitude? How seismic is the trajectory of a successful company in your mind?
So the beauty of biotech is it runs the entire gamut. This is probably the most volatile corner of our portfolio, and successful companies can be a 10 or 15x within 1 or 2 years. And so when you have the most,
those are crypto numbers.
So when you have that, you don't need a very high hit rate. The thing I will say is that this is a portfolio, right? So when we look to construct it, about half of our biotech holdings do have revenue. So you're not going to get a 10x out of those generally, but you can get a 2, 3, or 4x out of those if the market is much bigger than anyone thought it was, if the uptake is much stronger because the drug works better than thought, or if people miscalculated what the net revenue per patient turns out to be. All of those things happen on a day-to-day basis, which is why it's important to have a model. But then, so we kind of, we have a portfolio with some riskier and some less risky holdings in the biotech side, and also on the medtech side as well. Medtech tends to be, those companies are often profitable, so that tends to be more conservative. And when we're out on the farther end of the risk curve, we would be more exposed to biotech. Our portfolio is generally 25 to 30 healthcare holdings, and our overall small cap portfolio is about 100 to 30 holdings. Understood.
So it's funny because the last conversation I had was with a gentleman that ran money in ETFs and had $4 to $5 billion. And I was shocked at the level of confidence, for lack of a better way of put it, he put upon his use of AI to generate ideas. How much AI usage is going on in the biotech space, and how much specifically at Emerald?
So I'll answer first in the biotech space. I can tell you that most pharma companies are trying to figure out, is there a way to use AI? Because kind of the holy grail is that AI can understand human biology so well and understand chemistry so well that it can create drugs that would work super well in
Right.
humans. And that's the dream that some people have, right? A ways away from that actually materializing, but there are some companies testing it, and pharma, they're all trying to do it as well. For the most part, the way that we're using AI, it's kind of boring. Like FDA just came out with some guidance recently, and they're talking about, companies can use AI to fill in forms, to write the regulatory documents. The regulatory document itself was probably written by AI for all I know. But FDA is starting to use it. So it's handling a lot of paperwork, writing big, long, mundane documents. I know companies are like, I heard recently that like 95% of an S1 can be written by AI. So we have a lot of that stuff going on. It's just kind of boring and not glamorous, but it does save time and effort and money. At Emerald, we are still evaluating how best to do this. I have an idea and a project in mind that I'll be working with somebody on in the future. My hope is to, since there's so many publications and expert doctor call transcripts in the public domain, and then I can just feed the PDFs, I'm hoping to kind of create a subject matter expert in a like given therapeutic area by feeding it all the information, and then hoping it can kind of project what's going to happen. But that's a dream and a project that I have on the back burner, but that's what I see this could maybe potentially be for me on the buy side. So plenty of time.
Interesting. So talk to me a little bit about, you guys have mutual funds, separately managed accounts for some of your institutional or even retail clients on that front, but you just launched an ETF. What's the ticker on it? And talk me through why someone would buy it.
Yeah, sure. So we have been doing this for 30 some years, and it's becoming apparent that the mutual fund world is moving towards ETFs. We said we need to get there, and healthcare has been one of our top performing verticals, and healthcare is the first ETF that we've launched. So the ticker is LFSC, Larry, Frank, Sally, Charles. And we've been trading since late October. So we're 5 or 6 months into this. And what you'll see if you look at the holdings of that, it's very, very, very similar to what we have in our mutual fund and separately managed accounts for healthcare. We have a couple names in the ETF that are not in our other accounts, and vice versa. The reasons to invest in something like this is because we have a couple tailwinds in healthcare, aging population. I think everyone would agree we're all getting older, and we all need more medicines as we get older. And the sequencing of the genome, as I mentioned, really opened up a lot of opportunity in healthcare. So there's a lot of innovation going on in healthcare. One of the key drivers for performance in the life sciences space, especially biotech, is going to be M&A from the larger companies. Pharma has a gigantic patent cliff coming through the end of this decade. By 2030, they'll lose almost a third of their revenue. About $300 billion in drugs will go generic. And smaller companies are pretty much the driving force of innovation for the entire world when it comes to biotech. About 2/3 of the drugs that are in clinical trials are held by smaller companies, and the big companies are going to have to acquire many of these to fill this gap they're looking at over the next 6 to 8 years.
So let me understand this patent cliff a little better. So they're moving off of their patents on their big drugs. All of a sudden, they're going to go generic. And whether they have a generic drug in that space, obviously the margins get squeezed down, the profitability gets squeezed down massively. Are you now saying that they look to backfill and buy small cap companies to put them in their drug pipeline because they're able to charge more, or because they're accessing a different disease, what have you, that's going to address a different market, or some combination thereof?
Yeah, so you understand stocks very well, and companies need to grow for
Give me
stocks.
more credit than I deserve.
So pharma companies need to grow, right? No one no one wants to see the pharmaceutical space become a value space trading at a PE of 2 or 3 or 4. That would be problematic. So these companies need to grow. When you have 30% of your revenue going generic, and you're right, going generic means margins get crushed. You pretty much write it off for the most part. So they need to fill their pipeline. In a perfect world, they would have had such a strong pipeline from the profits that they've generated so far from that drug that they have the replacements and then can grow on top of it. However, they don't have the replacements. Pharma does a number of things really well. They're okay at R&D, but they're really good at selling stuff. So they have big sales forces. They're really good at litigating IP, and they're really good at lobbying. So when
that's a very positive light on the space at large.
I mean, there is a lot of innovation, and they do bring us very, very, very important molecules and drugs, but they don't discover most of them, is what I'm saying. So they handle the commercial arm of it, and they still do R&D. The pharma spends about 20% of its revenue on R&D, but the amount of innovation. It also sounds
like, based on something that you said before, of these mass, like wide breadth addressable markets, they have the deep enough pockets to back the testing on the front end, like a GLP-1 that a biotech company could never back because it's too wide of an addressable market. There's too much litigation and long-term effects that they don't know.
And even smaller companies, they don't have the bandwidth to even go to like primary care doctors. So you probably know your primary care doctor is the person that you hopefully see for an annual physical. That person will never learn about a rare disease. That person will refer you to a medical geneticist if you have something very serious, or a kidney doctor if you have a kidney problem. My small companies can detail those geneticists and kidney doctors, but they can't go to primary care. That's an order of magnitude larger scale than they can do. Also from manufacturing, like there are some small cap companies making GLP-1s right now or trying to develop GLP-1s. And even just the manufacturing lift, it's like, this is going to cost a couple $2 billion to set this up. How does this work? And that's where you need pharma with its bigger pockets and better scale.
So going forward, and maybe we can kind of round this conversation out on this topic, the here and now, when you look at the opportunity going forward in healthcare, specifically in small cap in the biospace that you're in, where do you see the upside coming from? And it could certainly be a combination thereof, but is it coming more so from there's depressed valuation right now due to regulatory concerns, RFK, higher interest rates, et cetera? Or is it
taking all the loose money?
Yeah, fair. Every loose change has rightfully so gone to technology. We'll see when that changes. Or is it more so the innovation is so real and ripe right now that it's going to drive profit margins and in massive growth? So I guess it's one of two things here. Is it revenue growth, or is it margin expansion, or is it some combination thereof?
It's a combination of all of the above. So I'm getting to the spot where I'm like, wow, I have a whole big long list of stocks that make sense on a DCF basis. It's like these things are trading below where they should be. The struggle that I'm having is, like, if you look at the ownership of some of my biotech companies, it's all specialists like me. It's like me and a bunch of hedge funds. It's like we're just trading amongst each other. There has been no incremental buyer because they've all gone to tech.
The nerds are there, and that's it at this point.
The nerds are there, and we know these are legit drugs. So the question is, do the more generalist investors come and discover this stuff? Because these are the types of things they like to own. It's like, this thing is going to be a drug. I'm 80% confident, which is about as high as you get in biotech. I'm 80% confident it's going to work and be approved. The problem is it's not going to be approved for 2 or 3 years. And in the meantime, there's not enough action to keep people like me interested. So what do you do with it? So that's one of the struggles that we have. Generalists love to own that kind of thing, because it's like they're not going to get blown up for 2 or 3 years. And they're like, yeah, look, it works on an NPV basis, and pharma's probably going to buy it at some point in time. It's just really hard to know when that happens. So that's one of the things that's going to help. We do have on the med tech side, we do have very fast revenue growth. So small caps broadly will be driven by superior revenue growth, but it's just the market being so enamored with the large stuff in tech has really been a massive headwind to healthcare. So as a result, our sector is about as cheap as it's been for a very long time on a relative basis.
you've got a massive curveball getting thrown at the market right now in the big cap tech space. So it'll be interesting to see if that shakes anything out, and then money's got to go somewhere. So where does it go from there? And valuations, to your point, in your space sound like they're pretty darn cheap.
I was talking extensively to our tech team yesterday because it's very important for me to understand, is this a one-day blip, or is this going to be a change in the way the market is looking at risk assets, and do they want to switch from tech to something else?
Yeah. And I mean, you guys in the small cap tech space right now, biotech is usually large cap growth. And right now they're almost trading a little bit more like a value tilt almost to them, just based on where their multiples are, is what it's sounding. And that's potentially where you can get that seismic shock of revenue growth, couple that with margin expansion, couple that with valuation multiple turns, and that can be pretty seismic shocks higher.
And also the level of innovation that's having, and getting some clarity on what's happening in DC, which I think is coming in the next couple months.
Well, Terry, we appreciate the heck out of your time. It's not every day that we get a doctor on the line that works for a firm that manages $4.5 billion or whatever it is, that is a portfolio manager in a very narrow sleeve of the market that is ripe for potential upside valuation moves. So thank you so much for the time today. We appreciate the heck out of you, and hopefully you'll come back here in 6 months or so, and we'll talk about the upside that we've seen in your product and the market as a whole in the biotech space.
Thank you. I'd love to do that.
Awesome. Thanks, Terry. Talk soon.